Good evening, everybody. This is Jeff Scott. Sorry for the lateness of my presentation, but I've been traveling this weekend. And let's get this into presentation mode and let's get going. This is HGSI Doc, and this is my top-down review for August 28th, 2016. I entitled this one as Fed Wavering Stirs Up the Bears. There's my contact information, and let's go. Disclaimer, this is for education purposes only. Anything I recommend in the spirit of education and should not be considered investment advice. I'm a doctor, not a broker. I'm not registered by any authority. I am not affiliated with any software vendor or trading company. I pay for the tools that I use, and trading involves risks, and you alone are solely responsible for any decisions you make. As always, I like to call out the pillars that I learned from, and it's really two worlds. The world of cancelim is introduced by O'Neill, improved by Morales and Catcher, and taken to the computer and made even better by Ian Woodward and Ron Brown. Balanced and matched up with some of the things I've learned from John Person, author, trader, mentor, friend, software creator, who has just a great way of looking at taking trades, who hasn't changed his basic story in 20 plus years. And when it still works as the markets change, it suggests that he's got some good ideas. A little bit of Ann Tharp for money management, position sizing, and my buddy George Lee, who I believe will be having another summit in Southern California in October. I own a lot of software products. I use a few of them. TradeStation or Thinkorswim are my real-time platforms. I've actually been playing around with the latest version of Ward & Brothers TCNet, and I've been able to create a lot of the indicators I use in that platform, so you may see me be using more of that. I like its real-time scanning during the day, and I'll show you some of those values over the next few weeks. HGSI is my go-to analytic program for after hours and intraday. EdgeRater is another great program that interfaces nicely with HGSI. I'm a seasonality fan. I think the best program on the market right now is Seasonality Trader, and I use a number of different websites. Back to seasonality, there's three main colors. There's the Best Choice, there's the Magenta Trader, and there's Seasonality Trader. And each one, I think, has its value. Magenta Trader's gone through some corporate issues. It's now web-based, keeps getting more features and improving. Best Choice is an old platform that's about to relaunch with a HTML, I believe, based product with new ownership, which is exciting. And then I'll use Seasonality Trader probably some tonight. Here's the website for HGSI. I point out two things. One, a free 30-day trial. He does not even ask for your credit card information. And the other is under investing strategies. You'll see two names to pay attention to. Well, there's many names, but my name is there with all the different webinars that I've done over the last many years. And then Ron Brown, who's just great at learning things and then showing how to do them in HGSI, is a frequent contributor. We're now less than a month away for the the seminar in Florida in late September. If you've not registered and you're on the fence, now's the time to make a decision. John's program is going to be Saturday, Sunday, and Monday, starting on September 24th. My program will be optional. It's on Friday. If you're only coming to my program, it's $400, $300 if you're going to John's. My contact information is there. I need to know because I've got to finalize numbers. Stock patterns are cyclical, and this is really for 18 months, 2 years, has been a tough market to trade, although from February until July, we had a pretty rip-roaring stage 2 markup of prices. But we remain in this period of time now where it's still questionable, as you know, we've been in a very narrow range now for a number of weeks, kind of in this uncertainty stage. Do we break out higher, which I've been hoping and thinking we might, or are we going to break down? And we'll see. This is an important slide, although I won't spend much time on it. And what it really relates to is you don't trade each cycle the same way. You have to figure out where the marketplace is, where your stock is, and you take positions based upon your overall feeling of what the market is doing. You don't go long stocks when you think the market's about to trash. At the same token, when you're at a bottom and you're going up, you want to load up on stocks and calls. So how you attack the market is going to vary by where you think the market is within its cycle. So let's take a look at some of the things from the end of the week. On Friday, interest rates ticked up. The dollar firmed a bit. Janet came out and hemmed and hawed and basically said nothing. And then Fischer came out and was a lot more hawkish. As a result, the market traded up, traded down, and tried closing back higher than the bottoms, but still down on the day except for the NASDAQ. Clear strength in the finances, and that includes regional banks, big banks. Insurers were mixed, but I saw a lot of nice insurer stocks, and even the broker-dealers looked pretty strong. Technology was strong, and we'll look at Facebook and Amazon today. They look like two of the strongest stocks in the system. Semiconductors, take a look at the SMH if you want to see strength. Healthcare services and biotech rebounded some on Friday, and social media had some strength. What was weak? Home builders, materials, energy, gold, retail, utilities, discretionary, staples. So there was a lot of weakness and strength limited to just a couple of those groups. The major markets, something that is new to point out is that, again, on the next two pictures, E-minis in the upper left-hand corner, the NQ, the YMs, the TFs, the VX, and the DX. This is daily. You have daily sell signals now on the E-minis, the NQs, the YMs, but not the TFs, which is the Russell futures. The VIX moved up a week ago and went sideways during this week, and the dollar had a big move, recovery move on Friday. We'll see if it can get through that 50-day moving average. So you clearly have new bearishness, still sideways without a 1% move, but clear-cut bearishness, and you might wonder if we're going to come down and test 2139-ish on the S&Ps or the E-minis, 4620 on the NASDAQ 100, 18200 on the Russell futures, and 1210 on the Dow, and then 1210 on the Russell. And I just picked those numbers out because those would be natural places expecting support at the 50-day moving average. I'm not writing this off. I'm not writing off the chance of a move up, but right now you've had to get a little bit more bearish based upon the picture. Looking at the weeklies, you still are in a buy signal on the weeklies, E-minis, NQs, YMs, and the TFs, and you're below the major moving averages on both the dollar and the VIX. If I look, however, at Genesis, and Genesis has a little bit different algorithm, so sometimes it fires before TradeStation. First column's the E-minis, second's the NQs, the third is the TFs, the fourth is NYSE, and the fifth is the YMs. And you'll notice across the top, which are daily, we have a sell signal across the board except for the TFs. On the weekly, sell on the E-minis, sell on the NYSE, and sell on the Dow. So the larger stocks are on a weekly sell. Monthly, everything's in a buy. If we look at rates, if we look at the 10-year on the left and the 30-year on the right, you could see they both come off their lows. Kind of a nothing week on the 30-year, but the 10-year showed a continued rise, which is good for banks, especially regional and insurers. If one looks at the AD line, so for these pictures, the spiders, which we're going to use as a representative of the market, will be in yellow, and whatever entity we're talking about will be in white. So the AD of the Russell 2000 is actually setting new highs, while the 1000s, the little stocks pushing higher, the larger stocks sort of rolling over a tad, and so some divergence here supporting smaller stocks. That's interesting. The NASDAQ composite still lagging on the NASDAQ versus the market itself, the NASDAQ AD line versus the market. But notice how the NASDAQ 100 is lock, stock, and barrel. Is this continued move up on the NASDAQ AD line while the market sold off? Is that a convergence or positive divergence that suggests that the NASDAQ may power higher? Percentage of stocks above the 200-day SMA here. This has been a line over the last many years of When we hit this line, the market usually sells off. So we are in this overbought territory in regards to the 200-day moving average. Interestingly, in regards to the 40-day moving average, we continued to fall down with less and less oversoldness. So how do I interpret this? Is it longer term we're still overbought rather, but short term we're becoming much less overbought. The other interpretation I have is we're maintaining higher highs or stability in the indices with reducing participation of leadership. Looking at the 3-month new high, new low ratio, very reproducible when it gets up to between 98 and 99% of the new high, new lows. If you look at the new highs and new lows over a 3-month period, when 98 or 99% of them are highs versus lows, it tells you you're at an extreme and you've dropped back down to 60%. Reversals usually occur at a much lower number. And we've already come off the top, again, reducing participation. The daily McClellan, again, sideways to up, while the oscillator and the summation index are heading down. And you could argue that you've got a number of zero line breaks or failures here on the daily McClellan. On the weekly McClellan, also negative with higher highs on the stock market. Again, I think that's negative divergence and other additional evidence that breadth is waning. The buckets are still bullish with 55% of the stocks in the S&P 1500 above the midline of their Bollinger Bands. Now probably as many stocks in red buckets as there are in green, so clear weakening despite maintained indexes. No evidence of a HINDY, which is good because no major bear market has occurred in the last 50 years without signaling a Hindenburg. I look at it both on the traditional all-NYSE and on the right on the Russell 3000 as I wonder the impact of all these interest-bearing and bond-type funds in the NYSE as the number of traded instruments has dropped from 8,800 down to 4,500. And how does that impact things like the Hindenburg? Clearly, bearish sentiment increases. If you look at the HINDY indicator, and this would be in the third group, you notice the reds and the yellows and the paucity of greens. We've gone from a bullish trending market to one of indecision with a hint towards bearishness. Now, canaries in the coal mine. One of the bright spots in this market on Friday was the NASDAQ. In fact, the NASDAQ was positive on the day, led by the NASDAQ 100. And Facebook and Amazon look poised to lead this market higher. If this was a stock, I have a stock in an uptrend, pull back to support right below the PSAR dot. The Canaries, which is sort of a artificial index made up of the large NASDAQ 100 stocks, the leadership over the last couple of years, looks poised to go higher, although it's stalled after a recent run. Certainly hard to be negative looking at that chart. Know your earnings and news. So if you look at the news, the Case-Shiller, consumer confidence, mortgage numbers, employment, pending home sales, and then we've got Friday, first Friday of the month, non-farm payroll. So this will be a very busy month. Now, Fischer did insinuate that we could see a September rate hike. A couple weeks ago, I talked about how I expect the Feds to talk rates up and then do nothing. You know, think about it. Our national debt interest rates are tied to what the Fed rate funds are. So if they start raising rates, we'll have less ability to pay our national debt. I think it's talk and hype. I do think with the rest of the world showing weakness and still easing, it will be difficult to raise rates at any kind of a cadence. And perhaps the whole goal here is to talk king dollar higher, because a higher dollar will have some of the impact of higher rates and would also lead to a flow of funds ex-US into our markets as being a safe haven. To the right, you see that it's a relatively quiet earnings period this week, but I highlighted some of the very, some of the popular, Abercrombie and Fitch, retail apparel has done very well. My pick Guess had a nice Bible gap up this week. Palo Alto Networks, big in the cyber warfare space. Vive, a cloud stock. Ollie's Bargains, a new retailer. A couple of other retailers here. Sienna, Lululemon, and then a couple of my stocks that I own, Ambarilla and Avgo, Broadcom, all with earnings this week. So although it's a light week for earnings, it's not a light week if you own those stocks. Here's my thoughts of the market. Interest rate sensitive stocks rise in the second potential rate increase. I still doubt we're going to get a rate increase in September, but Fischer did open the door. We also saw volatility rise, and that may be something to keep an eye on. When the VIX is low, look out below. When the VIX is high, it's time to buy. The VIX is still low. From an earnings perspective, less bad than expected becomes the new winning story, the new good. Bond prices ease as interest rates start to creep up. I have a short position in the TLT, which frankly I was getting tired of holding because it wasn't working. We'll see if that happens now. Dollar did bounce a bit on Friday. Metals fell and have weakened over the week. As EPS season wanes, will the U.S. election and other news events drive the market, which leads to more volatility? And as I've said several times, it's pretty clear to me that leadership's narrowing as indices are holding near their all-time highs. Tonight's agenda, we'll do a top-down review, look at some of the industry groups, some bottoms-up, and then show you my chart of the week. The chart of the week is presented for education purposes only. Trading, especially options, carries risk. I do not warrant any expectation of return. I may or may not already have a position. I may or may not follow what I recommend. I plan on taking the trades, however, if they execute, so I can discuss. And I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. Last week, we talked about Guess jeans. I was interested in Guess because of the retail apparel. There were several Bible gap ups within the group. Everything turned green above, coming out of a mobile breakout from a squeeze. Kahunas, OBV was strong, recent pocket pivots. On TradeStation, you saw a bottoming formation with new PPS weekly buys and daily buys. Here was my trading plan, and I planned on buying 1,300 shares. Now, interesting thing happened. Market has a lot higher than where we said to get in. It barely hit the stop, the buy stop, and it probably didn't trigger for you because it barely hit it. But, you know, it was a troubling week as we pulled down to the sell stock, and ultimately we broke out with a Bible gap up. So this would have been a tough trade to have taken and stayed into. Our logic on picking it turned out to be correct, and the stock had a huge move. I mean, from, you know, a buy of $15.95 area and a $2 move plus over a $2 move. It's about a 15% move on the week. And we'll come back to this week's chart of the week, which you can cheat and see down in the lower left-hand corner. All right. So first thing is I always like to go into TradeStation and get a sense of what's working in the market. So NASDAQ in a sell signal, weekly is still in a buy and monthly is in a buy, so short-term sell. So that's weak, but it hasn't given up the farm yet. The Dow, short-term sell signal, longer-term buy signal, blue on the weekly with this MACD divergence, so some definitely weakness there. S&P, same story, sell signal, blue on the weekly with the buy signal, and monthly buy. So in a long-term uptrend, we've got some weakness in the shorter time frame. If we look at the Russell 2000, different. Certainly the strength right now, as we mentioned before, looking at the charts very quickly, buy signal on daily, weekly, and monthly. So the Russell's where the strength of the market is. And the Qs, despite their positive performance on the end of the week, are still in a sell signal as well. So no question, there was some weakness in the markets at the end of the week, and that shows on the major market indexes. Very quickly, materials in a new sell signal. We talked how they were weak Friday. Energy in a sell signal, but still blue on the elder impulse. Financials, As I said, these are one of the strength with the rising interest rates, and they are remaining a buy signal on all three time frames. Industrials, a new sell signal. Technology, another strength in the market, remains in a buy signal. Staples, sell signal. Utilities, a new sell signal. Healthcare, a sell signal. And discretionary. So if you want to know where the strength is, it's pretty simple. The strength in the market is in financials and technology. Financials and technology. And it'll be interesting to see what happens with biotech and some of the energy stocks. I mentioned semiconductors. Here's a SMH. Look at the strength here. Superstar. All right, let's go into HGSI. Major WB user group full. Let's go to top-down view. So, strength in the market. Never good when the dollar's up top with gas and oil. There's your semiconductors. There's volatility. Small stocks close to the top. If you look on the bottom, you got your S&P and your S&P 100, the Dow Jones Industrials, mid caps near the bottom, gold bonds, NYC Composite near the bottom. If I look at 5-day performance, I can see volatility was up 20%, the dollar was up 1%, everything else was down a little bit, except for gold, which was down over 9%, silver down only 3%. Let's take a look at some of our favorites and see if we get a sense of what the market's likely to do. We know there were no kahunas on Friday, so let me go to the clean little view here. So the weekly HINDY on the S&P is still in a green, okay to be long signal, and you could see a pattern that clearly looks like it's topping, although could have said that over here, it topped, over here, it topped, and over here it looked like it was doing the same thing, and it broke out to new highs. So we've got some weakness here. I still think that the 50 is a natural target if there's a pullback. It wouldn't shock me to see this to move up this week, but we will see. So the S&P 500 tiring. The Dow Jones Industrial looks just like the S&P 1500, getting a little bit closer to a natural bounce point at the 50. The NASDAQ one composite. Whoops, that's bonds. Again, a big leader here, just going sideways as it gets in the area of all-time highs. The NASDAQ 100, Amazon, Facebook, similarly looks at its all-time high level. If we take a look at bonds, I know that they've been selling off a little bit. Bad day on Friday. Be interesting if they break through this support. Can they come back down to the 131 level, which would make my short position very happy. And be a natural place where you expect bonds to bounce. A lot will depend on the hype about interest rates. The dollar, strong, but it's still strong in a downtrend and has to get above the 50 and 200-day moving average, and that may be some resistance. Volatility index, not as low as it's been. It looks like it's about 13. And what did it close at? It closed at 1143. It's been as low as 1102 there, 1140 there. So it's moved up a little bit. That's got to be more than I said. It's got to be 13 or 14. It ended up at 1365. So it's about 20% off its lows. So a rising VIX is not a what you like to see if you're long stocks. You want to be buying stocks after it pulls back. You want to be getting very careful when it starts to move up, and it looks like it wants to start to move up. So the dollar had a bit of a comeback, but was still weak on the week, and gold really has that pattern of topping or certainly slowing down. I would not be chasing gold here. I'd let gold try and set a new base and stop falling. That's gold. If I look at gold miners, a much bigger drop, even the Bongo weekly. And now look at how good the weekly Bongo was. The weekly bongo went green about where this line is. So sometime when I broke above the 50. It stayed green until within the last week or two, capturing the vast majority of this gain. When I see a weekly bongo go red, I don't want to be living there. Oil, sort of going sideways here, range bound, I would say. Looked at fix. Guess that's it. Now let's take a look at where the money's moving. Go to all securities. You can see there are 171. I look at the 2-day force up, and only 30 of these groups are positive. Let me make sure I got the order right. And if I look at negative, I can see that there are about the same number to the downside. Notice some of the groups here are some of the groups that are to the downside. I point out REITs, interest rate sensitive, telecom carriers, interest rate sensitive, steel have been strong, specialty chemicals, home builders, consumer finance, a number of things that might be interest rate sensitive, as are the utilities. To the upside, and remember, this is a very short-term movement. Semiconductor devices, I showed you the strength of the SMH. We'll look at a couple of these because I think there's some viable things in here. So let's go into my favorite view. So remember, for those that are new, green is good, blue is good, red is bad. Up here we have the bongos, which are sort of my timing indicator, the long-term and then short-term, accumulation distribution in the middle, and then a long-term and short-term force index. This is the high jump bar with high red candle highs and green candle lows. The next button down is Bible gap up, squeezes, MOBOs. Dark gray here is the group strength. Magenta is the 8-day exponential, then the 17, 50, and 200 moving averages, simple. Pocket pivots, these down here are kahunas, and that's OBV with the moving average. So Micron is a stock that, that little pattern I talk about, went through that pattern and looks like it's back up in a new phase of markup. So Micron is what I would call broken out and moving, kind of orderly here. Everything is green. I don't like its earnings per share growth, its fundamentals. Old name, certainly showing a lot of life. Not my favorite, but it's certainly been working. AMD, another old name, a lot steeper ascent, still relatively cheap stock. Everything is green. Again, I don't like its earnings per share growth. Had a couple kahunas. I'm not sure I'd be entering it now, but if I owned it, I'd be happy and I'd be holding it. I do have a substantial position in Broadcom. Earnings are coming out this week. I'm tempted to take profits or sell into the money call against it. Based upon what happened with a couple other things that are in the market. But we are at all-time highs. This is a merger that had Broadcom and AVGO came together. They kept Avgo's ticker and took Broadcom's name. I'm certainly a leader in the semiconductor space, and what a great move this has had. Everything is green on the weekly and the daily. As I said, I'm tempted to take profits because if you're missing and your guidance is bad, you're getting hammered. But a nice pattern nonetheless. Skyworks has broken out of a downtrend, got above the 200, makes money but not a lot of growth. Qualcomm, another one broken out and running, setting up a base here, nice earnings per share growth. I think that one's interesting. So quite a few nice stocks in the semiconductor area. Internet media, I think Facebook looks good here. This was almost my stock of the week. Facebook, let's just make it a little bit more space here, has been basing now for about 6 weeks. Showed some strength on Friday, a couple of kahunas and pocket pivots last week. Mobile breakout out of a squeeze. It has great earnings per share growth, even though it has a high multiple. Its growth rate is twice its its multiple. I think Facebook goes higher, and I'd like to see it test out this 130, 129 range, at least as a start. It's funny, I got into Facebook with a loss in that I shorted some puts, and the stock got put to me. Fortunately, I had enough margin account that I didn't have to cover right away the stock. And it's had just a great run. This is about the time that I was short puts, and it knifed right through the 50 weekly moving average. So Facebook, I think looks interesting here, basing nice day on Friday, mobile breakout from a squeeze, pocket pivot, and kahuna. Weibo's had a big run, had a little bit of a gap up on Friday, probably getting close to the area, worry about an exhaustion gap. Love the earnings per share growth. Everything is green. Weibo looks interesting. Cena, sort of a high base and wants to break out here. Everything is green. Good earnings per share growth. Yahoo, benefiting from the Alibaba shares. Don't know how to play this one. And there's Yelp. Certainly strength in the internet media. Banks, as I mentioned, banks are showing some benefits because of the rising interest rate concern. This is BOFI. This is one that I've highlighted a few times. It's broken out and running. It had a doji on Friday. Already run. I try and find things that haven't run rather than look at a ton of banks. You could just go and look at either KRE, which is a regional bank story, Pure Play, and looks a lot like BOFI, has broken above its moving averages. You could look at XLF, which includes insurers and large stocks, a similar pattern. Or you could play individual stocks. Regardless, I think banks are going higher. Infrastructure support software. So Rackspace, which is a support, I thought they had hardware more so than software. I guess it's as a cloud play and got taken private. It was an interesting call. It had a Bible gap up, pull back to support, and really looked like it was getting ready to run. And it gapped up a couple bucks on Friday with a takeout. I think the takeout was based upon its trading price down here, and this is where news of the takeout caused the stock to move. Now, it was interesting because I did a synthetic where I was short $30 puts and long $30 puts. And had I just gone long $30 puts, then I probably would be losing on the trade, even though I was right on the direction, right on the timing, because it's really capped out now at about 32, 32.50. But I made money on my short position. So I took that position because it allows me to get in cheap. And when something like this happens, I close out the short position right away and try and milk the long position for as much as I can. Checkpoint software, way below the 200. Looks like it's reversing here, but it's too down for me. Acme, I like this one a lot. This one, it worked its way above the 200-day moving average and failed. It's now broken above it, had a PSA reversal, pocket pivots, OBV is strong, and its Bongo green, weekly just went green. I like Akamai Technologies. Next group down, and this is what I do every night, application software, Autodesk. Bible gap up on Friday. Take a look at this on a weekly stock chart. Kind of a long period of congestion here, and now breaking out to all-time highs. Old name, new run. Excuse me. Workaday, a little bit less exciting. NetEase, big move. Looks like it wants to run again. Momo, another one of these momentum names. I have a position in this one. This one continues to push higher. Really is getting extended. You can see the high jump bars at the height. It's in the right group. Getting extended. Hard to buy this now. Salesforce.com, pull back to the 200. Now sitting and struggling at its 50. So this is another technology group that is a leader. Communication equipment. So really driven by the first couple. Acacia is a IPO that ran from 30 up to 124. Pull back. Looks to me like it's going to run again. Big momentum play, but great earnings per share growth. Cisco Systems, an old name, had a doji on Friday. I'd like to see which way it opens. Makes money, although not much in the way of earnings per share growth. Pays a 3.3% dividend. Radcom, don't know much about the stock except there's been a huge jump in revenue. Earnings are lagging. Excuse me. This is the beauty of HGSI, where I can go down from a top-down perspective. Packaging companies, several of them popped on Friday. I found out why when I read the news. WestRock pays a 3% dividend. I like KS, which is the third one down. IP pays a 3.6% dividend. KS pays a 2.3% dividend. Broke above the 200-day moving average. Everything is green. Mobile breakout from a squeeze. Strong group. Love this picture. Look how revenues move from the 5s up to the high 7s. Buying it at where you can put your stop right below that 200-day moving average. 2.3% dividend. Why did the stock go up? Because they passed through I'm not sure if it's a big price increase, but they passed through a price increase, which is good if you want to grow your bottom and top line. Big banks, not to be outdone. As I've said before, I continue to hold a long-term position in Bank of America. It's trying again. Over the last several years, it's had several attempts. Here's a weekly. The last time it was sitting here, it had a nice run, went sideways and sold off. I think Bank of America is a nice place to be. It pays a 1.3% dividend, does make money, and is this the year that big banks start to move? If you like that pattern, then you'll like JP Morgan and Citigroup, which basically here's Citi, here's JP, all have the same pattern. Wells Fargo's a little bit weaker. Medical devices have been strong all year. There was some crazy stuff going on with a recall on somebody last week. Here is Medtronic. Looks like a reversal here. It's still below the 200. I'd probably pass. But if you look at why it got in here, it was up 1.42% on Friday and has a 6 million share volume. Zimmer Biomet Holdings, great run, sideways. I'm waiting for a signal that it's going to run again. Boston Scientific, a slow but steady Eddie mover. Had some pocket pivots last week. Kahuna's off the 50. Very buyable here. I own this for some time. It's like watching the grass grow. Just a very slow mover, but a very attractive chart. And Stryker's in a downtrend. And the last group, number 10, payment and data processing. Like this chart a lot. Bottom line technologies, if you want a cheap stock with a probably a low risk purchase. A Bible, well, not a Bible gap up because it's below the 200, but I think a Bible gap up on Friday with multiple kahunas, a mobile breakout from a squeeze, everything turning green, makes money but not much earnings per share growth. This is bottom line technologies. And PayPal Holdings has started just basically basing as it sorts out what it wants to do. So there you have the top 10 groups and some of the stocks that I found in them. The next thing I do is I typically have built a buy watch list, and that buy watch list are some of the best of those stocks from my top-down review, supplemented by a few other maneuvers. Here was the buy watch list that I came up with. Now let's look at what's in here. We got application software. I mentioned Momo, SSNC is another one. I got a couple of banks. These are two smaller banks. I've got I got a diversified bank in Bank of America. E-commerce discretionary. There's Amazon, JD.com. A couple of expirations. Some internet media, including Facebook again. Insurance. oil and gas, REITs, nice showing from semiconductors, and a couple specialty apparels. These are the stocks that I will put into my watch list and I will trade this week if things set up their way. Just very quickly, I'll go through, actually make sure I got them ranked the right way. All right, so we've looked at Bank of America, broken out and running. I like this one a lot, especially if interest rates go higher. Amazon, doesn't that look like Facebook? It's in a relatively tight range. Probably doesn't go below that, well, hopefully stays above the 50-day moving average, which is sitting at 744. Right below the PSAR dot, had a pocket pivot in Kahuna on Friday, mobile breakup from a squeeze. I think Amazon wants to go higher. Facebook we looked at, Alibaba, flagpole, now a pennant. So I guess based upon what I learned from Ian, here's my pennant, and I had a 16% move, 13 points. I'm probably would expect 60 to 70% of that. It's another 8 or 9 points when it breaks above that descending trend line. I'm going to watch Alibaba, looking for a Kahuna, pocket pivot, Bible gap up coming in. Tiffany and Company, another one of the retailers with a Bible gap up, Kahuna's pocket pivots. Guess we mentioned already. Bottom line we mentioned. C-Trip, a internet-based media. Thought this was like a travel thing. Yep, travel in China. Really sideways. A nice day on Friday with pocket pivots and a mobile breakout. AMD we looked at. Momo we looked at. Weibo we looked at. Applied Materials, what a nice lower left, upper right. Certainly it's extended. It's got great earnings per share growth. Growth rate 5 times its multiple. I think there's room for multiple expansion as well as increasing earnings. We looked at KS. I looked at a bunch of oil plays. There wasn't a whole lot that I wanted to take on the expiration. I already have Devon and a couple of others. This was Canaries, broke above its moving averages here. Everything's turned green on some pocket pivots. Makes money with some decent earnings growth rate. Here's that regional banking play. JD.com, I'd like to see it get above this 200 and hold. If it does, it would become, I think, a very bullish play. Look at the group strength. Everything is green. E-Trade, I mentioned a lot of the broker-dealers were benefiting from the talk of higher interest rates. Look at E-Trade picking its head up above the 200, having a PSAR reversal, mobile breakup from squeeze, pocket pivots, and Kahunas. Schwab and Ameritrade also look good. One of my favorite retailers over the last decade, or 5 years at least, has been Burlington Stores. You can see why. What a move since 2013 here. And continues to go higher. I believe earnings came out already, and they were positive. Yeah, next earnings not to November. I like to buy this on weakness. Akamai, I already pointed out to you. NVIDIA, like Burlington, what a beautiful lower left, upper right, earnings per share greater than its multiple. I think there's room for multiple expansion and growth. This is a leader in our time, a little bit of a pullback. I'd like to see some momentum come in. Terraform Power, 5.7% dividend. They trade in various power. Why did I pick it? I picked it because it's 5.7% dividend. There's a lot of demand, and it's sitting right on support with pocket pivots, Kahunas, and mobile breakouts. Boston Scientific, we looked at. Univar is a specialty chemical player. This is the pattern I'm seeing a lot of small moves up, followed by, potential breakouts. But here's a small move up on Univar. Everything looks green with a pocket pivot. Great earnings per share growth. That's what attracted me there. Hillrom Holdings is a healthcare medical device. This has been a hot group. Looks like it wants to go higher. CBL and Associates was one of the few REITs that made my interest, and I think I got interested in their great earnings per share growth and their 8% dividend. Ambarella, one of my holdings that has earnings this week, so you have to be careful. GoPro's earnings were good. GoPro's got some things making people want to buy it. That's probably argues good things for Ambarella stock, not based upon earnings per share growth, but based upon sort of the story. And this is one of my favorite patterns we're seeing now, breaking out, retesting, and just a nice, slow moving run up. Energy Transfer Equity, this is a MLP, pays a 6.3% dividend. Same pattern, broke above it, tested, and now just a slow move up. You're really playing this one for the dividend and some small growth. Masimo, another medical device company, broken out and running. Pull back here to the moving average with a pocket pivot. Looks like it wants to run. Great earnings per share growth coming in. Manpower, I believe this is a staffing company. Why I picked this one, let me see if I can remember why. Had a pocket pivot and a new weekly bongo turned green. Deep pullback, looks like it wants to run back at least up into the 200-day moving average. SSC Technology, waiting to break out right below the PSAR dot. Everything has turned green. Cinmarex, this is one of the big winners on the oil exploration story. High price stock, currently about $135. Look at the earnings per share growth coming into the stock, in a stock that has recently been losing money. This once was in our leaders index years ago, maybe 3 years ago when it was a high flyer. Looks like it's a high flyer again. Plains Group Holdings, another MLP, slow mover but 8% dividend, good earnings per share growth. Supernus Pharma, I like this is a pullback to free parking and then a kahuna. That's one of the scans that I look at. I don't like the red up here that the weekly bongo, the daily bongo's red and the weekly forces red, but I do like the pullback to support. Notice how many times on this move up that the 50-day moving average was support. No dividend, earnings per share growth coming into the stock with some revenue. UVE, again, it's that pattern of a break, a long downtrend, break above the 200, a retest, and a slow move, pays a 2.3% dividend. This is just one of many insurers. If interest rates start to go up, these will be strong. Spark Energy is a utility, another electronic and gas marketing and trading company, pays a 5% dividend yield. It's got great earnings per share growth, broke above the 50, strong volume. Still weekly bongo red, so it was not my pick of the week. NMI Holdings is another insurance company. It's already breaking out and running. Legacy Financial is a retail, is a Texas bank rather, I believe. Great earnings per share growth, 2% dividend in a group that's working now. Innovia is a hope. I believe it's going to work. The fundamentals are incredibly strong as they've now launched some products. Revenue is growing, earnings are growing, so are the red bars growing. So it's got to break out and prove itself, maybe set a stop above the PSAR dot. Right now I'm watching it. As I said, this is my watch list. And Olin Specialty Chemicals, great earnings per share growth, did sell off hard in July, so you have to understand what happened there. This looks like it's basing and getting set up to run again. Mueller Water Products, water is the new gold in oil, and you could see a broken out, a retest, and a beautiful run up here. Good earnings per share growth, pays a 1% dividend. Third Point Reinsurance, another insurance company, got that little move up on Friday with some momentum. Hilltop Holdings, I believe another Texas bank. This one has investment brokerages as well. Everything is green up here. This is one that would be my squeezing right below the PSAR dot, looking for a trigger. So I, again, watch list and look for a reason to jump in. TG Therapeutics is bottom fishing, a pharma stock that had some news. And Penny Park Investment is the slow mover here that pays a 14.5% dividend. Central Garden is consumer staples. Is this the pet supplies or outdoor supplies? Lawn, garden, and pet supplies. Big move up, pull back here, look for momentum, come in and resume great earnings per share growth, but on a low earnings base. So those are the buy stocks that I looked at. Now what I do is I take these buy stocks and I take the high close dojis and I go into this thing here and I basically went through a large list of stocks to find the ones that I thought were best for this week. Let me show you a couple of them. We're going to skip Amazon for a second. ePay, that's that bottom line technologies. Why did I like it? Clearly in a downtrend, high closed doji, weekly PPS buy signal today. OBV is below its average, but it's moving back up. Had a buy signal 3 days ago on the daily. We have a Bible gap up, pocket pivot, mobile breakout, PSAR reversal, and a kahuna. Look great. OBV on the daily has moved up. This was tempting and is one that I'm going to look at playing as well. I mentioned E-Trade, again, a high closed doji on Friday for the weekly. OBV crossing over its moving average on weekly and daily. It's also in a buy daily. Guess Jeans really had a great move. I don't necessarily think they're done moving. I left it up here because I wanted to show you today, not saying to buy it now, but this is one that we chose last week, and it had a great week. Manpower, when we mentioned, is I think a staffing firm, did have a weekly high closed doji. And this specialty chemical company, a weekly high closed doji, a new PPS buy weekly, a PPS buy daily, and OBV looks fairly strong. And then TGTX, again, this is a bottom Fischer with some news, but it does have a high closed doji. And notice how OBV is breaking out while price is still bottoming. So the one I picked for this week, let's go take a look at that and look at a couple things in seasonality. Let's go to seasonality first. So to me, this market looks like Facebook and Amazon. So let's just take a look at Amazon. Earnings are nowhere close, so I'm going to leave it on 52 weeks. And what does it show me? It shows me that we're about to go in August 18th to September 28th, so we're in the midst of a 7 out of 10 years positive performance with an average return on the positive years of 11.5% and a negative 2.2% on the down years. So 11% up, 2% down, 7 out of 10 years, 70% winners. That's pretty strong. Part of why you'll see Amazon was my pick of the week. Facebook. We'll see if it comes up. Come on, Facebook. All right, we'll try it one more time. All right, here's Facebook. We are on the dotted line. Here's the next earnings. So Facebook also in the midst of a strong period of time, only 4 years of trading, up 4 out of 4 years, 18.5% average return. So Facebook has interesting. And then what I do on things like Avgo with earnings coming out, I take a look at it and I see orange. It doesn't help me. 5 out of 10, 7 times it's up, average 9%. That's pretty good. I'm probably going to take my profits before earnings come out. We'll talk more about it next week. Sometimes what I'll do, since the volatility is so high, is sell a short-dated call at the money and use that as some protection if the thing sells off. Since I own calls, not stock, I'm only at risk my profit dollars and what I bought the call for. But sometimes it's better just to take your profits off the table. Ambarella also doesn't look great, negative more than it's positive. Case in point, DY, great seasonality, 7 out of 10, 10%. And what happened with DI is it came out with earnings. Right? E here is for earnings. And it gapped up in the morning and sold off the rest of the day after they came out with their story that suggested some issues with forward earnings growth. You've got to be very, very careful holding stocks at earnings time. Now, one of the things that I like to do is I like to look at a calendar and start looking at a couple weeks. And let's just look at stocks that have a 90% winning average, at least a 10% change. Minimum price, let's make them $8. And we're going to hit go. So here are stocks that met my criteria over the next couple of weeks. Calidus Software, 9 out of 10 positive. Average return 14%, starting August 30th, which is in 2 days. Earnings are not until November. So here's a stock that over the next 2 weeks is up 9 out of 10 years, 14.17%. That's what I lose seasonality for. So now I might look at, back into HGSI, out of curiosity. I like sitting on the 50-yard line here, right below the PSAR dot, pull back in an uptrend. I won't touch this without momentum, but this is going to go on my buy list, and I'm going to be looking intraday for a PPS buy signal, maybe an HCD, maybe a pocket pivot, maybe a kahuna, and be looking to get in. I love that story. So other things that I do, didn't really go into my scans much this week, is I will typically go into all securities here and go into, let's just go look at my smart groups. Let's just change this. Let's just use a simple scorecard, which is technical and fundamentals to rank them, and go down to the smart groups, open my name up, and look at what stocks had a 3 times move in volume last week. And I only want things that were up. But there's that rack space. Here's that Radcom that I mentioned had a nice pattern. And that bottom line technologies. So I often look at high volume stocks to find something. How about stocks that have a pullback to the 50 MA with a kahuna? Here's that Boston Scientific. See what Becton Dickinson Company looks like. Uptrend, sideways, pullback to the 50 and a new kahuna. That looks great. It's a $200 stock, which is why I didn't pick it. Maybe what I'm going to look at will be the group that has PSA reversal to the upside. So these have to be squeezing and right underneath that PSAR dot. So a number of the stocks that we looked at, because this is one of my favorite places, including Amazon and SSNC. So I'll go through my scans, I'll build my watch list, and then I end up with a couple of plays. Let's talk about my pick of the week, and then we're going to say good night. So I'm going with the big boy and tell you how you can trade it with not a lot of money. Again, these are education purposes only. Trading as specialty options carry substantial risk of loss. I do not warrant any expectation of return. I may not already have a position in stocks. I plan on taking the trades if they execute. And blah, 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 blah. Now, keep in mind that I'm going to closely monitor futures overnight, be watching the market. I'm not leaving an order out there unless I get a sense what the market's going to do. If market sells off hard, I'm probably not chasing things to the long side. I chose Amazon. Here's why. So, uptrend, long-term uptrend, going sideways, sitting right below that PSAR dot. On Friday, mobile breakout from a squeeze. Everything turned green. The weekly bongo's been green for some period of time. The OBV is heading up the right way. It had a kahuna and a pocket pivot on Friday. If I looked at it on TradeStation, it's in a weekly PPS buy, strong OBV. It had a brand new daily PPS buy and strong OBV. And if I look here, it's where I merge the two, where it has, I know from my dots, a pocket pivot, a mobile breakout, a squeeze. Hasn't reversed the PSAR yet, and it had a kahuna. So I'm thinking that PSAR is at 770 and 20 cents. So I'm going to put a buy stop somewhere north of 770 and 20 cents. And I'm going to look back 4 or 5 days, and this is the weakest day in 4 or 5, and say, you know, if it gets above that PSAR dot, I want to go long. But I don't want to give this too much room to run. It's a toppy market. I could have picked the blue, the 50-day moving average, which is currently at 744. I could have picked a round number like 750. I'm not giving this one a lot of rope. So I'm going to put a buy stop in at 770, which is right above the high on Friday. I'm going to put a stop at 752, which corresponds really to the lowest bar in 20 days, touched a couple of times, and also corresponds to the current last conditional change, which is one of John's top secret sort of stops, trailing stops. I'm risking $18.25, which is 2.4%. So that's not a lot of room. And I can buy 100 shares for every $2,000 of risk capital I have. So a little bit of how I'm going to look at this trade. This is in Options Pro. I put in Amazon, and I put a number of different bullish scenarios. And I could do a bull call spread where I'll buy the lower call and sell a more expensive call, a higher price call. It costs me a little bit of money, and so the most I can lose is the premiums I paid, but the most that I can win is the difference in the two strike prices minus the premium. Not a bad maneuver. You could probably do a lot of contracts because it's relatively cheap, but you have a limited gain. A bull put spread. I'll sell a higher price put, and I'll buy a cheaper put to protect me. I will get paid premium for taking the trade. The max I can make is the premium I get for taking the trade. And the most I could lose would be the difference between the two strike prices minus the premium I take in. A bull put spread is a safe trade. It requires some margin, but you've capped your margin exposure, so you can still get a lot of shares. But again, you cap your upside. If I'm bullish in a stock, why would I want to cap my upside? I'm not going to educate you with call ratio back spreads, but let's just suffice it to say, after spending a little bit of time with John, those have become my favorites. I could go long call, long stock, short a put, which has huge risk if the stock drops, or a synthetic long. So let me show you what I'm going to be looking at. This is taking a long position in Amazon. And anytime I take a long position, my break even is the price I pay, which is about $7.69. And what this shows me is that if the stock goes up, I make money. If the stock goes down, I lose money. Okay, it's costing me to buy 100 shares. It's going to cost me $76,900. That's a hell of a lot of money. So I probably don't have a lot of takers for that on this webinar. My break even is the price I bought minus the commission fees or plus the commission fees. The most I can lose is everything I paid for the stock. Stock goes to zero, and my game is infinity. So what I want to do is, can I come up with a trade that has an infinite gain and starts to attack my risk or the amount of money I have to put out to make the trade? So here's two ways that I like to play that I get the gain with a lot less pain. So the first one on the left is a synthetic long position. Notice it looks identical to a long position. In a synthetic long position, I am buying the long call, which in this case is going to cost me in the neighborhood of $14. If I'm long a call, I make money if the stock goes up, but it has to go up more than $14 for me to cover my costs. So the stock is at $7.69. I got to get to $7.83.45 to make any money. That's not a high risk trade, a high probability trade. On the other hand, well, it's a high probability trade, but it's not a guarantee. Let me put it that way. On the other hand, if I go long a call, all I can lose is that $14. But this has the same loss as going long the stock, because what I did is I sold a put. So by buying a call and selling a put at the same strike price. I pay out on the call. I get paid on the put. I drop my acquisition price to $1.95 a share. Or if I bought 100 shares, it's only a $195 debit. The problem with this trade is my maximum risk is still the $76,900 and some dollars. So I get the exact same upside as buying the stock. I get the same downside, but I do it in a way that my out-of-pocket is much less. Now, one thing that I do, which I call my chicken shit spread, is I may sometimes actually buy a put somewhere out of the money so that I cap my losses, which also caps my margin exposure. This is another potential trade. And this trade, I'm going to sell a call at the money to generate some cash. And then I'm going to buy 2 calls that are a little bit out of the money. Now I've got a couple different exposures here. I'm paying cash out of my pocket on this trade, and I'm still potentially at risk between the 2 strike prices. So now my break even moves from 769 to up here. I think it's about a little bit over 780, 783. But I have all the upside opportunity. I've capped my downstream risk. Stock drops below 767 here. They both expire worthless. So my maximum risk on this trade is 1390. I've got infinite gains, and my debt is 1140 to control net 100 long shares. So do I want to buy stock and put $76,000 to control 100 shares? Do I want a synthetic where it's going to cost me $195 to control 100 shares, but I have $76,000 risk? Or how about where I make it a little bit tougher on me because I'm pushing my break-even price up, but I'm now paying $1140 to buy 100 shares, and I'm risking a max of $1,390, which is going to be gentle on my margin account. I will probably take some type of a call ratio back spread. That's become one of my favorite ways to play expensive stocks. And it's simple. If the stock pops, then I will very quickly close out the short position, and that will mitigate some of my margin exposure. I may finance closing that out by selling some of my longs, because I bought 2-to-1 longs for the one that I short. I may just close out the short position. If the stock falls, then my position becomes worthless, and I may actually buy back the short position with hope that the stock rebounds and I've got just a pure play long position. But I'll talk about these at my meeting. I learned them from John Person. I never heard anybody else talking about them. I've gotten pretty excited by call ratio back spreads. And on that note, just to remind people, I do have a user group. If you have John's lifetime indicators, you're welcome to join at no cost. If you have interest in his indicators, please reach out to me at hgsidoc@gmail.com. I mentioned the seminar. We'll see you in Florida. I'll stop it here. Y'all have a great night.